Stronger than expected jump in US retail sales further fueled the idea that the Fed won't be in a position to cut its interest rates this summer and that the Fed's next move could actually be a rate hike. Growth in China surprised on the other hand this morning, but the data was quite mixed and the US dollar gained across the board. The dollar yen spiked past the 154 level as equities fell. So welcome. This is Swissquote's Daily Market Talk. So a stronger than expected retail sales data from the US cemented the idea that the US economy remains too strong for the Fed to start cutting the interest rates in summer. So retail sales jumped 0.7% in March on a monthly basis, more than 4% on a yearly basis. The 3 and 6 month bill auctions in the US were weak, and Atlanta Fed's GDP now forecast rebounded to 2.8%, meaning that the data really so far in the US actually hints at a 2.8% growth in the first quarter in the US. That's really not bad at all. Then, China posted a surprisingly stronger than expected GDP number this morning, showing that the Chinese economy grew by 5.3% in the first quarter of this year. That's comfortably higher than a 4.8% growth penciled in by analysts. But the sky is not blue in China. It never is, because the industrial production missed estimates. House prices continue to fall, and the consumer spending slowed way more than expected during the month of March in China, hinting that the underlying problems of the Chinese economy, like property crisis and weak consumer confidence, are not going away so soon. And remember that last week saw Fitch cut the country's outlook to negative, citing risks to its public finances, while in contrast, somehow Goldman Sachs and Morgan Stanley, they both raised their outlook for the country's economic growth, pointing at improved factory activity in China and recovery in exports. But the EU started a deluge of investigations on China that actually could hurt the country's export outlook in the future, along with the risk of seeing Donald Trump become the next US president. So with all this in hand, the contradictory expectations regarding the Chinese economy and mixed economic data certainly explain why the CSI 300 index slid despite a 5.3% GDP growth, while Shanghai's composite fell almost 1.5% today in China. Now, a strong Chinese GDP may have not boosted appetite for Chinese stocks this morning, but it sure boosts worries across the board that rising Chinese growth, regardless of where this growth comes from, will fuel global inflation and hence make major central banks like the Fed and ECB think twice about their rate cutting plans, because while the European Central Bank and the Bank of England are actually seen cutting their interest rates between sometime this summer and this fall respectively, the outlook becomes much more complicated for the US Fed, because provided that the economic growth and jobs market remain very robust in the US and inflation is now heating up, the idea that the Federal Reserve's next move will be a rate hike starts cooking quite well in many investors' minds these days. In this context, UBS now thinks that the Fed could increase borrowing costs all the way up to 6.5% next year to combat inflation. Ouch. So the fading Fed cut expectations continue to pressure the US Treasury markets to the downside. The US 2-year yield, is preparing to jump probably sustainably back above the 5% psychological mark. The US 10-year yield advanced past the 4.60% level yesterday, and the US dollar index extends gains. The euro dollar is trading a touch below the 106.15 level this morning, with euro bears eyeing a further decline in the euro dollar toward the 105 psychological level, while the dollar yen spiked above the 154 level, the unthinkable at the start of this year, as the yen bears defy the Japanese authorities' intervention threats, and T Rowe Price now calls for another 10% slide in the Japanese yen. Ouch. Now, in equities, the S&P 500 had, a bad start to the new week with a 1.20% decline on Monday as technology stocks led losses in the US. Nasdaq fell 1.65% yesterday. Both indices slipped below their 50-day moving averages following yesterday's sell-off. Now, while strong economic data from the US is not necessarily bad news for company earnings as consumers continue to spend, it's just that. The rising inflation in the US and the fading dovish Fed expectations and also this latest optimism regarding earnings expectations could actually limit the upside potential that we might see in major stock indices in the US if, of course, company results fail to beat high expectations. So the fear sets in and the VIX index rises rapidly. Now, a small parenthesis here speaking of earnings. Goldman Sachs, surprised in the first quarter with a 28% jump in profit, but JP Morgan and Wells Fargo's first quarter results, didn't enchant investors last Friday, remember. Bank of America and Morgan Stanley will be releasing their quarterly results in the coming hours today, and, Bank of America may announce a narrowing net interest margin as at JP Morgan and Wells Fargo last week, while Morgan Stanley is expected to post its ninth consecutive quarterly drop in earnings. And later this week, Netflix will begin the dance for the major US technology earnings that will be followed by Tesla next week. A lot of earnings, a lot of spice in the markets these days. Now, speaking of Tesla, the company said that it will cut 10% of its global workforce to adjust to slowing EV demand globally. And in fact, we all know that Tesla has had a bad first quarter and there is not much suspense regarding the weak quarterly results that we will probably see next week when the company will release its first quarter results. So the first quarter deliveries fell 8.5% for Tesla, while the EV sales overall globally increased a bit less than 3%. So that meant that Tesla lost market share despite cutting the prices of electric cars. So that's a problem. A major problem because, lower car prices were already criticized by many investors out there as they waited on the company's profit margins, and losing market share on top of it despite lowering prices, calls for immediate action from Tesla to increase its profitability level. So price increases for the cars and cost cutting are the first aid measures that should soothe investors' nerves in the very short run, while bringing forward new revenue streams like robo-taxis, for example, should keep investors dreaming for a bright future for Tesla. Yet the context of slowing EV growth and rising competition globally will likely continue to weigh on Tesla's profit margins, and robo-taxi segment is a niche and quite a slowly growing segment which won't show in the bottom line in the immediate future. Therefore, while Tesla, which has a P/E ratio of nearly 62, which is high, has further room to extend losses to settle at a more reasonable valuation. In this context, a slide toward the $100 psychological mark is not impossible. Now, another troubled technology giant in the US is Apple, which saw its iPhone shipments fall by almost 10% in the first quarter of this year. So Apple shares fell more than 2% on the news following an almost 7% rebound during last week on the company's announcement that it will now produce its own AI chips. Now, we know that the next earnings season may not be bright for Apple, but Apple has one and a very important advantage over its competitors, and it's its brand value. And because Apple is not considered to be a cutting-edge technology company by many investors out there, but a luxury brand instead, a sufficiently satisfactory AI offering to clients could help the company boost its profits in a large proportion compared to its peers. Therefore, there's a greater chance that we see a further selling pressure in Apple's stock price in the coming weeks, which could actually be interesting opportunities for investors who still love Apple to increase their Apple exposure at interesting prices. So voila, this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.